the 2007 to 2012 crisis, there were plenty of laws in place that could have prevented that, but people didn't have the will to do it, and regulators in particular. And Alan Greenspan, unfortunately, a very smart man who's been absolutely wrong about everything, along with Larry Summers. Two very smart people have just been repeatedly wrong about many, many things.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Got a special guest for you today who's written a book that you definitely want to take a look at. It's entitled A History of Major Financial Crises and How Taxpayers Pay the Price. And taxpayers always pay the price for everything. That's one thing I've learned in my short time on this planet. Her name is Kathleen Day, a faculty member over at Johns Hopkins University. Hey.
Thank you. I got a little buzz there. Let me just say the absolute correct title of the book. It's called Broken Bargain, Bankers, Bailouts, and the Struggle to Tame Wall Street. And it is a history of financial crises. It's a history of financial crises in the United States, going back to the founding of the country, but with a real focus on the modern ones.
So bank crises, bank failures is nothing new. It's been going on since some guy came up with the idea that you could put all your money, everybody puts their money in a bank for safekeeping, and then we trust the people who are supposed to be watching the money for us. And then, out west, they'd, in the history of the U.S., they'd go take off and they'd wind up in another country or whatever with all the money they were supposed to be watching. Nowadays, they just take it and they don't worry about anything.
Well, it is not quite as simple as that. And banks, with all the looking at and criticizing of finance and the many ways in which it has gone off the rails in the last 200 and some years, we also need to remember that finance is a integral and key component of the economy, and finance and the many ways, even debt, borrowing, lending, insurance. There's many ways in which finance is a key cog in the economy.
Yeah.
Hamilton understood that. Jefferson understood that. The difference was that, and they both knew it was dangerous. The difference was Jefferson thought that it was overly dangerous and that we shouldn't have it. Banks were overly dangerous. Hamilton recognized that they were dangerous. We just needed oversight, and it's the failure to oversee. And it's broader. It's really Wall Street now. It's really the financiers are. It's a little bit broader than just commercial banks.
Right. And going back to the Great Depression, it was found that one of the major reasons for the collapse in finance and banking was that the commercial banks had kind of merged with the merchant banks, the investment banks, and they split them up. And we wait 70 years and then we're back to where we started from again. Is that
you always have to remember there's two components of regulation. One is the rules, one's the oversight. Now, some people will say, but we have what's going on now because we deregulated. And you have, it's true, but really, and Silicon Valley Bank really points to this, you can have deregulation, you can have fewer rules, you can say banks can do more things or bankers can do more things, but you then have to have more oversight. Time and again, it's a failure of oversight, that the regulators just get too cozy. So before the 1930s, we had basically no rules. And the precursor to Citibank, today's Citibank, there was a guy who led it. His name was Sunshine Charlie. And because he had outwardly such an optimistic look. And he's the person who really pioneered the idea of bringing investment banking and commercial banking together and getting the regular rank and file person to buy shares in the stock market. So he brought that component of investment banking to mainstream America. And and of course there was no regulation, so it went haywire. So he was head of a company that both lent money to buy stock in the company, and then it was just a can of worms rife with conflict of interest. Then the 30s come along, and you have Congress say, let's separate investment banking from commercial banking. Let's put a cap on what they can pay depositors. And we are going to create the Securities and Exchange Commission. We're going to start having accounting rules. There were no accounting rules before the 1930s. Then you fast forward to the 1980s, really, and that starts coming apart. The separation becomes meaningless for a variety of reasons, which I can go into, but I don't know if you want to do that.
Right. So, but we have a history, no matter what regulations are in place, no matter what laws are put in place, these banking crises crop up at regular intervals, right? Is it a cyclical?
No, they do. They absolutely do, because people have amnesia. They forget. They start thinking that we won't. It's a new era. That was a mantra in the 1920s. It's a new era, wealth without work, and we had that again in the run up to the 2000s with the tech bubble. People said, recessions are over. It's a new era. So there's that. And then there is just plain old-fashioned doing things they shouldn't. So the 2007 to 2012 crisis, there were plenty of laws in place that could have prevented that, but people didn't have the will to do it, and regulators in particular. And Alan Greenspan, unfortunately, very smart man who's been absolutely wrong about everything, along with Larry Summers. Two very smart people have just been repeatedly wrong about many, many things. So it could have been prevented, but people didn't have the will. They either, I think Alan Greenspan was blinded by ideology. He just thought, the markets would never do anything that would put themselves out of business. And of course, in the short term, they did, because people are thinking of their short-term compensation. So they're not really worried if they're doing something that long-term is going to torpedo an organization, as long as they get their compensation for that quarter. But in any case, sometimes it's caused by amnesia, and sometimes it's caused by people just, there's so much money being made that they convince lawmakers there's no problem, even though there obviously is.
Yeah. And so what about the concept? I think now we have little or no reserve requirement. Once upon a time in the world of fractional banking, it was 10 or 12%. Then it went down to 7 to 5. What impact does a reserve requirement have on preventing these?
It's not that there's no requirement, but the idea is, look, if people tend to be more risk averse, they tend to take less risk when their own money is at stake, and they tend to take more risk when other people's money is at stake. So if I lend you a lot of money, you won't necessarily go out and do silly things with it, but you're more likely to do silly things with borrowed money than if you had your own savings at stake. And so the idea of a reserve is to have a capital cushion, a money there to absorb losses or problems before you then have to tap taxpayers, because banks have deposit insurance. That is a guarantee by U.S. taxpayers, even though banks pay an insurance premium into it. The problem is when the sun is shining, those premiums, you pay the premiums, we have the deposit insurance, people are happy. But on a rainy day, when people are worried about the safety of their funds, they will tend to withdraw funds in larger amounts than the bank anticipated, so they don't have the cash on hand. And so the bank then either has to liquidate, and it can go through its capital cushion very quickly. And so it will then have to liquidate its assets, the loans that it has made. And those people weren't expecting to pay their loans so quickly. So they typically will have to pay them back for cents on the dollar. That's called on Wall Street taking a haircut. So the bank has to take a haircut on those loans, and that depletes its assets on its book. So if you have a liquidity crisis at a bank, the reserve is supposed to help protect against that, and it might for a while. But if the run or the demand for deposits continues, the bank's going to have to go into its assets. And the point is, a liquidity crisis can cause a bank's liabilities to exceed its assets, and that pushes the bank into insolvency. And then the bank has to close, and then taxpayers have to pay off whatever shortfall there is, because we've promised depositors we will.
Right. So in terms of today, bringing it current, we got other banks that are on the ropes. We just had First Republic, quote unquote, be acquired by JP Morgan Chase. How is this banking crisis? Is it different from the others? And is it going to end cataclysmically, or will the regulators be able to put out the fires and bring everything back to normal?
Well, the regulators have already issued a report on themselves saying, hey, we did a terrible job. They're always beating their chest and saying we did a bad job, and yet they do it over and over again. Because when the sun is shining, they start saying, hey, we don't need umbrellas anymore. Let's reduce reserves. Let's reduce how often a bank has to do a stress test. Let's reduce the size of the bank that has to do a stress test. So when the sun is shining, they say we don't need umbrellas, and then it starts raining. I hate to keep using that analogy, but it's very apt. It starts raining, and they say, hey, what happened to all those umbrellas? We got rid of. So today's crisis is strikingly similar to what happened in the 1980s. It was, but again, every crisis has its own unique characteristics, but they also all have, they share characteristics. And the economist Kindleberger at MIT, now deceased, was one of the pioneers in chronicling that there are similarities. There are often similarities. So what happened in the 80s, there was an interest rate mismatch. Banks were paying depositors more than they were earning on the loans that they were giving to customers. And so today, Silicon Valley Bank, which ignited this crisis, what happened is that inflation went up and it was holding too many treasuries securities. Now, treasury securities are super secure, or they will be until we've default on our debt, and then they're going to be deemed not so secure, and that's a whole other issue, and that will cause its own crisis. But for the moment, they are secure, and they were secure, but they were holding too many of them as part of their capital cushion. So when inflation went up, and that triggered a demand for deposits among some tech industry folks who were also hit by inflation, they went and tried to get their money out. And the problem with bonds, which is what treasuries are, the principal is what people will pay for it goes up and down with interest rates, because people will want to lower the price of the bond so that their ultimate yield will be at today's yield. So when Silicon Valley Bank went to redeem or sell its treasuries and get the cash, because treasuries are thought of as near cash, but they're not cash, they're near cash. So when they went to convert that to cash to meet the withdrawals, they found that those treasuries had lost value because of inflation. They were still safe in the sense that had anyone defaulted on it? No, but they were worth less, I think it was like $2 billion less. So they had a big, I forget, maybe it's 2.8, I forget the numbers, but they had a huge shortfall because they had too much money in bonds rather than actual cash, and the regulators had let them do it.
All right. So interesting times ahead.
So I don't know what I didn't answer your one question. Do I think this is going to be a huge crisis? I don't know. It has similar characteristics to the 1980s in the sense that it had to do with inflation and interest rates, but I don't know that this is quite as deep or prolonged as what was in the 80s. Time will tell. I may be wrong, but things have surprised us, especially during COVID. The economy was much more robust than we thought. Inflation is slowing. What will really cause a crisis if we default on our debt?
All right. Well, hey, we appreciate that insight. Our fingers are crossed that the erstwhile regulators will be able to straighten things out and keep it from the fire from becoming a conflagration. Obviously, the markets, investors are on pins and needles and hoping, the one thing that struck me about Silicon Valley Bank is that they let it get to that point. The Fed had to have known that they were on the balls of their feet and that they were approaching insolvency or had already crossed the line into insolvency. And they could have just closed that bank on the weekend, gone to one of the majors and said, you're now the proud owner of Silicon Valley Bank, like they did with Bank of America and Merrill Lynch. They said to Ken Lewis, Ken, welcome to the brokerage business. You are now the proud owner of Merrill Lynch. And he said, what? We don't want it. No, Ken, you didn't hear us. You are now the proud owner. And he capitulated because he has no choice. Why didn't they do that here? That is the big question to me, because that fed the rest of the fires.
Well, the fact is there was no need for Silicon Valley Bank. Well, the dust hasn't settled completely. We won't know everything about Silicon Valley Bank. It's always worse once you get in there. I'm quoting Paul Volcker, former Fed Chairman Paul Volcker. It's always worse once you get in there. So we don't know everything yet, but it could have been prevented. They should have been watching the bank better. There were a couple things. It was overly dependent on the tech sector. So it's just like banks of yore being overly dependent on the ag sector or the oil patch. So when that industry goes down, they get in trouble. And secondly, again, where their capital cushion was a little bit bonkers. I'm not sure that it was necessary, but there were two things that happened during Trump era. They rolled back some of the safeguards that had been put in place post 2007, 2012 mortgage meltdown. One, and they're common sense things. These are the umbrellas. So during Trump, they said, hey, banks of Silicon Valley size, one of the biggest banks in the United States, banks of that size don't need to do a stress test. Bonkers. And guess what? These banks are deemed, they can go into more exotic things like hedge funds and crypto. Bonkers. So the bottom line is when you have taxpayers as the safety net. And look, you could do away with deposit insurance. I don't think we will, and I don't think it'd be very popular among voters of any political stripe. But if we got rid of deposit insurance, you don't need the oversight. Banks can fail, and people just take their losses. I don't think that would be very popular. If you have deposit insurance, you have taxpayers on the hook. You then need to have the government coming in because people become indifferent. That's moral hazard, the moral hazard that we talk about in finance, meaning that depositors become indifferent to the health of the bank into which they're putting their money because they know they'll get paid anyway, whether it's well run or not. And frankly, most people don't have the wherewithal or the time to really look and see if where they're putting their money is that safe. They just don't have the time and whatever. But so if the government has an obligation to go in and say, you should not be gambling with taxpayer guaranteed funds. And that's what banks were allowed to do when they're allowed to go into, that is what banks are allowed to do when they go into exotic things like crypto and other things. It's just ridiculous. We need to have stress tests for all size banks. We should not be allowed, in my opinion, I think that Paul Volcker, the former Fed chairman, was quite right, that banks whose operations are in essence guaranteed by the U.S. taxpayer should be very conservative in how they're run, and they should not be investing in exotic. They should not be gambling.
Exactly. Could not agree with you more. I wholeheartedly embrace that. Banks should be placed where they keep money, they make boring loans, they make boring profits. Everybody stays bored, which banking is a very boring business until times like today when it's not. So thank you for the book. Again, Broken Bargain, A History of Major Financial Crises and How Taxpayers Like You and I Pay the Price. And we have a link to Kathleen's site in the show notes of this interview on financialsurvivalnetwork.com. Just click it and you can order the book. And got any questions for Kathleen, myself, shoot me an email, kl@kerrylutz.com. Kathleen, we're definitely going to follow up with you in the months to come because I think you've got a better insight into what exactly is going on than most people out there. Hey, we wish you a good day, and we'll talk with you again soon.
Thank you so much. I appreciate it. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.